The rise of artificial intelligence is transforming industries worldwide, from healthcare and retail to manufacturing and finance. This technological revolution isn't just about futuristic robots or voice assistants, it's also a golden opportunity for investors. As companies race to harness AI's potential, the stock market is buzzing with possibilities. But what does investing in AI mean? And how can everyday investors tap into this transformative trend? Why AI is the future of investing. Imagine a world where cars drive themselves, doctors diagnose diseases with pinpoint accuracy using AI tools, and businesses predict market trends before they happen. This isn't science fiction, it's reality unfolding at a breathtaking pace. According to PwC, AI is expected to contribute $15.7 trillion to the global economy by 2030. For investors, this represents unparalleled growth opportunities in companies leading the AI revolution. Take Nvidia as an example. Originally known for its graphics processing units, Nvidia has become the go-to company for AI hardware. In 2023, Nvidia's stock surged by over 200%, fueled by its dominance in AI-driven applications like machine learning and generative AI. If you had invested $1,000 in Nvidia at the start of that year, your investment would have grown to over $3,000 by year's end. Such stories highlight the potential of identifying AI leaders early. But AI isn't just about tech giants. Startups and established companies in fields like healthcare, agriculture, and logistics are also leveraging AI to solve complex problems and enhance efficiency. For investors willing to research and diversify, opportunities abound. The many faces of AI investments. When people think of AI, tech behemoths like Microsoft, Google, and Amazon often come to mind. While these companies are indeed significant players, the AI landscape extends far beyond Silicon Valley. Investors have multiple avenues to explore. Tech companies are the obvious starting point. Microsoft, for instance, has invested heavily in OpenAI, the creators of ChatGPT. This partnership has integrated AI into everyday tools like Microsoft Office, revolutionizing tasks like writing, data analysis, and presentations. Alphabet is another leader, thanks to its DeepMind division, which focuses on cutting-edge machine learning and AI research. The healthcare sector is another hotbed of AI innovation. Companies like Intuitive Surgical are revolutionizing medicine with AI-assisted robotic surgeries. Picture a machine performing surgery with precision that exceeds even the most skilled human surgeons. Such advancements not only save lives, but also reduce healthcare costs, making these companies attractive investment opportunities. Then there's the automotive industry, with pioneers like Tesla and Waymo at the forefront of autonomous driving. By 2030, the global autonomous vehicle market is projected to be worth $67 billion, much of it driven by AI innovations. Imagine investing in the early days of this game-changing technology and reaping the rewards as it becomes mainstream. Even traditional industries like agriculture are leveraging AI. Companies like Deere & Company, known for their farming equipment, are now leading the way in AI-driven precision agriculture. By optimizing crop yields and reducing waste, these advancements address global food challenges while presenting lucrative opportunities for investors. The risks and rewards of AI investing. While AI offers immense potential, investing in this sector is not without risks. New technologies often come with a lot of hype, and not every AI company will succeed. Investors need only look back to the dot-com bubble of the late 1990s to understand the dangers of speculative investments. Many internet companies promised to revolutionize the world, but failed to deliver, leaving investors with significant losses. AI's rapid evolution could see similar pitfalls. For example, in 2023, AI-focused software companies like C3.ai faced scrutiny as their high valuations didn't align with their earnings. While these companies hold promise, they underscore the importance of balancing excitement with financial reality. Diversification is a key strategy for mitigating risk. Instead of putting all your money into a single AI stock, consider spreading your investments across multiple sectors and companies. For example, you could invest in a mix of tech giants, healthcare innovators, and industrial firms leveraging AI. This approach not only reduces risk, but also increases the likelihood of benefiting from AI's growth across various industries. Making AI investments accessible, you don't need to be a financial wizard to invest in AI. One of the easiest ways to get started is through exchange-traded funds. These funds pool money from investors to buy a diversified portfolio of stocks, often focused on specific themes like AI. ETFs such as the Global X Robotics and Artificial Intelligence ETF or the ARC Autonomous Technology and Robotics ETF provide exposure to a broad range of AI-driven companies, from startups to established leaders. Let's consider a hypothetical example. If you invest $5,000 in an AI-focused ETF with an average annual return of 8%, your investment could grow to over $23,000 in 20 years. This demonstrates how consistent, long-term investing can yield significant returns even with modest starting amounts. Another way to invest in AI is by purchasing individual stocks. While this approach carries more risk than ETFs, it allows you to target companies you believe in. For instance, if you're fascinated by autonomous vehicles, you might invest in Tesla or Waymo. If healthcare AI excites you, companies like Intuitive Surgical or Medtronic could be worth exploring. The long-term view. AI's future and your portfolio AI is not a fleeting trend. It's a seismic shift reshaping industries and economies. From automating mundane tasks to solving complex problems, AI's applications are virtually limitless. As an investor, understanding AI's potential can help you make informed decisions and capitalize on this transformation. The key is to adopt a long-term perspective. Stock markets can be volatile, and AI stocks are no exception. However, history shows that patience often pays off. For example, during the global financial crisis of 2008, the S&P 500 lost nearly 40% of its value. But investors who stayed the course and continued investing saw their portfolios recover and grow substantially in the following decade. Let's revisit Nvidia to understand the long-term potential of AI investments. A $1,000 investment in Nvidia in 2015, when its AI initiatives were just taking off, would be worth over $30,000 by 2023. Such examples highlight the rewards of identifying promising companies early and staying invested. Balancing risk and opportunity. While investing in AI is exciting, it's important to balance risk and opportunity. Savings accounts, for instance, still play a crucial role in financial planning. Experts recommend having an emergency fund with 3 to 6 months' worth of expenses. This safety net provides financial stability and peace of mind during unexpected situations. Once your emergency fund is in place, you can allocate the rest of your money toward investments. For short-term goals like a vacation or a car, a savings account might suffice. But for long-term objectives like retirement or wealth creation, AI investments can significantly boost your portfolio's growth. The AI revolution is already underway, and the opportunities it presents are vast. By investing wisely and staying informed, you can position yourself to benefit from one of the most transformative technologies of our time. Whether you choose to invest in tech giants, explore niche startups, or diversify through ETFs, the key is to start now and think long-term. Imagine looking back 20 years from now, knowing you were part of the AI revolution. By taking action today, you're not just investing in technology, you're investing in the future. The question isn't whether AI will shape the world, but how you'll leverage it to shape your financial future. However, the market can also be overvalued. But how do you know if that's currently the case? Check out this video and I'll explain.